So these are several ways of appraising an investment. Appraising an investment. Now, like as I've always said, it will be better to use an example. I'm just laying the theoretical foundation. So, God willing, next week when we do, God willing, next week when everyone brings their solution, we'll begin to break down that case, and we'll try to go through the, what do you call it? The actual questions. That's what we didn't do that at that time. Okay, so let's look at accounting rate of return, or what we call ROI. ROI. So let's look at this simple question. A company is considering a project which requires an investment of 120,000 in machinery. The machinery will last 4 years, after which it will have scrap value of 20,000. The investment in additional working capital will be 15,000, right? The expected annual profits before depreciation are 45,000. Year 1, year 2, another 45, year 3, 40, year 4, 25. The company requires a minimum accounting rate of return of 15% from projects of this type. ARR is measured as average annual profit as a percentage of the average investment. Should the project be undertaken? Should the project be undertaken? So that's the question. So this is a simple question on ROI or ARR. So first off, how do you think you approach a question like this? How do you think you approach a question like this? Very, very simple. You need to know the profits before depreciation. The profits before depreciation, year 1 will be 45,000. Year 2, 45,000. Year 3, 40,000. Year 4, 25,000. If you add all of that, what do you get? 45 plus 45 plus 40 plus 25.
155.
How much?
155.
Okay, 155. 155. Now this 155, these are your total profits. Your total profits before depreciation, right? Now we need to know what the cost of the investment is. What is the cost of the investment? What is the cost of the investment? The cost of the investment is 120,000, right? And then we are told that the machinery will last for 4 years and has a scrap value of 20,000. So it means that the depreciation, it has depreciated by 100,000. Remember that we know that profits before depreciation, not after, before depreciation to be 155,000. Now we know our depreciation value to be 100,000. And so if we take out 155 from 100, we're able to get profits after depreciation, which is 55,000. I hope that makes sense. Is it clear?
Yes, sir.
Okay. Now, what is the length of the project? The length of the project is 4 years. It's 4 years. So you divide that to, if you want your annual profit before depreciation, divide 55,000 by 4, you should get 13,000 something. What's the exact figure? What's the exact figure, please? 55,000 divided by 4. Anyway.
$13,750.
Okay, 13,750. 13,750. Okay, so that will be our annual profit. Annual profit. Our annual profit. Now, what is the formula for accounting rate of return? Did I mention that? I don't think I mentioned that.
No, sir.
Okay. So the formula, if you are writing, I didn't include it in this. I didn't include it, but it is the average, the accounting rate of return is equal to your average net profit divided by your average investment. Sorry. Your average net profit divided by your average investment. Your average net profit divided by your average investment. I hope that makes sense.
Yes, sir.
Okay. So what will be our average investment? What do you think our average investments will be? Ouch. What are the investments we have here? Hey. Okay, someone says something in the chat. The investment of 120,000. I see. Is that all? Is that all?
You can sell it for 20,000. That's the scrap value.
Okay, so do we have to add the scrap value to the investment, or like what do we do? What do you guys think?
Okay, so when you talk about average, you're just adding to some numbers divided by the number of times it occurred. So probably if you're looking at the average, you are going to look at the 120 plus the 20 divided by 2 because it's the average.
Okay. Okay. So the logic with the average is that looking at the actual cost of the assets versus the depreciated cost of the assets. So the actual cost of the asset is 120K. The depreciated cost of the asset is 20,000. So if you look at the average investments, it would be 120 plus 20 divided by 2, which is 70,000. If I'm right, it is 70,000. Now you cannot forget about the investment in additional working capital, which is 15K. Which is 15K. We are not given any beginning. There are no movements in that, like the machinery. So it's 15K straight. So 70,000 plus 15 will give us 85,000, and that will give us the average investment. Now we can divide our profits by the average investment, which is 13,750 divided by 85,000. Is that clear or is confusing?
Sir, please come again one more time.
Yes, so we have two things here, right? The investment is 120,000. The initial cost of the investment is 120,000. The depreciated cost of the investment is 20,000. Is that clear? Is that clear?
Yes, sir.
Okay.
Yes, sir.
So if you want to know the average costs of the investment, to be 120 plus 20 divided by 2.
Okay, sir.
120 plus 20 divided by 2. Now, the other investment that we have here is the additional working capital, which is 15K. It's 15,000. That's the additional working capital. So you need to add this 15,000 to the result you get for 120 plus 20 over 2, which is 70.
Yes, sir.
Then you get 85,000. Then you divide 13,750 by 85,000 to get your accounting rate of return.
Okay, sir. Thank you.
So your accounting rate of return would be somewhere around 16%. I'm not too sure what the exact number is, but someone can help me if they have a calculator. $13,750 divided by 85,000 should give us how much? I think about 16%. So the question is telling us, okay, the question is telling us the company requires a minimum accounting rate of return of 15%. So in this case, the project has to be undertaken because it meets the threshold. Now let's look at an example on payback. Payback. So we are breaking it down step by step. Payback. Okay. Can someone read the question, or I should just read? Can someone read the question? Payback. The payback question.
A company requires all investment projects to pay back their initial investment within 3 years. It is considering a new project requiring a capital outlay of 140,000 Ghana cedis on plant and equipment and investment of 20,000 in working capital. The project is expected to earn the following net cash receipts: year 1, 40,000 Ghana cedis, year 2, 50,000 Ghana cedis, year 3, 90,000 Ghana cedis, and year 4, 25,000 Ghana cedis. Should the investment be undertaken?
Fantastic question. Should the investment be undertaken? That's a good question. So when it comes to payback, I said that payback is the time frame it takes to recoup your investment, right? Now, It says it is considering a new project requiring a capital outlay of 140,000 and an investment of 20,000 in working capital. So these are the two investments. Like the previous question, we saw those two as well. So 140 plus 20 is 160, right? These two, 140 plus 20 is 160. Now that would be our year zero. Year zero, because that's an investment now. Anytime you hear now, it means year zero or time zero, whatever you want to call it. Now in year one, you have 40K, year two, 50K, year three, 90K, year four, 25,000. Okay, so let me just go to this answer part because that would help for you to understand it. Now you have year zero, 160,000. Year one, the 160,000 is a cash outlay or cash outflow, so it should be negative. It should be negative. Please, if you are not following, just say in the comments you are not following, because I'm trying to take my time for everyone to understand. So if you are not following in the comments, just say you are not following. So year zero will be minus 160, right? Year one would be 40,000, which we are given in the question. Year two, 50,000, year three, 90,000, year four, 25,000. Now, once you have this, you need to know the cumulative cash position at the end of the year. Don't forget that. So when you are doing your payback, always bring that. Always bring that. Very, very key. Always bring that. Please do that. Now, year zero, you have minus 160,000. So what will be the, nothing has happened though. What will be the cumulative cash position at the end of the year? It will be the same minus 160,000. In year one, however, we have a cash flow of 40,000, right? So what will be the cumulative cash position at the end of year one? It will be minus 160 plus 40. Minus 160 plus 40, which will give us minus 120,000. Is it making sense?
Yes, please.
Okay, so is this minus 160 plus 40? Yes, that's what I'm trying to refer to. Okay. Then in year two, you have 50,000, right? So what will be the cumulative cash position at the end of year two? To be minus 120 plus 50,000, which will give us minus 70,000. In year three, you have 90,000. What will be the cash position at the end of year three? To be minus 70,000 plus 90,000, which is a positive 20,000. In year four, you have 45,000. You have 45,000, which will be, so the cumulative cash position as at the end of year four will be 20,000 plus 45,000, which is 65,000. Okay, so once you have this figured out, you need to know when is the payback, right? When we actually.
Sorry, please, I have a question.
Okay.
The answer year four, the cash inflow there is 45,000.
Yes.
Yes, it's quite different from the one in the question.
How is it? Yeah, how is it 45,000? Because in the question, it's 25.
I think it's a mistake.
Yes, a typo.
Yes, a typo. It's a typo.
But when you look at the right side, there's a cash flow 25,000 plus 20 over there. I think there's supposed to be an explanation to that.
Wait, so hold on. I don't think. I think it's a typo, to be fair.
Or they added the 25,000 to the scrap value, if there was. And there wasn't even scrap value to.
No, there was no scrap value. So the cash flow is 25,000 plus 20,000.
So I get it. You see, at working capital, at the end of the program, you're supposed to recoup all your working capital. So the working capital at zero, because there was no any further addition of working capital. That is why we don't see working capital. At the end, we recoup all our working capital, which is the 20,000.
Wait, so let me see. Let me see what's happening. Oh, I get it now. I get it now. Okay. Can anyone see what's going on? Does anyone realize what is going on? I thought the question was even wrong. Does anyone realize what is going on? Interesting. Hello.
Hey. Hi, sir.
Does anyone realize what is going on?
Sir, can it be from the working capital?
Yeah, so yeah, it's from the working capital, but why is it from the working capital? That's what I'm interested in. Let me see.
Please explain it.
Okay. Okay. Someone was making a point, but let me see. Someone was trying to make a point, but let me see what the person was trying to say first. My mind wasn't there. There was someone making a point on working capital, but I've forgotten. I wasn't concentrating. Does the person want to speak or?
Sir, I was saying that the working capital, when you invest working capital, at the end of the period, you're supposed to recoup your working capital. So that is why it is plus 20.
Okay. Can you explain that a bit more? Like you're supposed to recoup it as in what? I think I agree with your line of reasoning, but I just want to see how you're thinking about it.
Okay. So you have working capital. Working capital can be either to inventory or receivables. But you know that those things, when you even invest in them, let's say you have inventory, you buy inventory. At the end of everything, at least you're supposed to get what you intend to sell or something. So at the end of everything, you recoup that working capital you're talking about.
Okay, so why is it that so your answer is correct, but why is it that we didn't recoup the working capital at year 1 or year 2?
Has at year 1 or year 2, the business was still in existence, so it may require more working capital or less. But since the question was silent on the movement, it's more reasonable to assume that at the end of the period, everything was taken back.
Okay, so let me explain. It's very, very simple. When you are beginning the year, obviously you need to invest working capital. I'm sure in your financial management class, working capital is something that it's basically your current asset minus current liability, something you need for your normal business operations, right? It's something you need for your normal, to be able to run your business, you need working capital. So at the beginning of the year, the project, you need that investment in working capital. Now that working capital goes into the business. You use it to run your business, but at a point it gets exhausted. Or you need to turn it around. It's like maybe you are, let's say you are into selling shirts, or you are into selling, let's say, mobile phones or whatever it is, right? The whole purpose of your working capital, because it's the capital that you use to do your normal business operations. If it goes down, once you push that money into your company, you are turning around that money. You need to turn around that money to make profits. You need to turn around that money to make profit. So what you see in year zero, what you see that happens is that there's an investment of working capital, year zero, right? In year one, the cumulative cash position at the end of the year is still in the negative. Year two, it's in the negative. Year three, it becomes positive. So let me just read what is there. It says, the investment in working capital should be included as an outflow of cash at the beginning of the project. That one we all agree. This is because when there is an increase in working capital, cash flows are lower than cash profits by the amount of the increase. Similarly, when working capital is reduced to zero, that is when working capital is exhausted at the end of the project, right? When working capital has been fully exhausted or is reduced to zero at the end of the project, the reduction is added to cash flows, because when there's a reduction in working capital, cash flows are higher than cash profits by the amount of the reduction. Okay, this sounds like a complicated explanation. It sounds like but basically what is happening is that, like our friend said, at the beginning of the period, this is an investment, and you need to recoup it at the end of the period. I don't know if that makes sense.
Yes, please, it does.
Yeah.
Okay. At the end of the period, do you mean at the end of the project also?
At the end of the project, sorry. At the end of the project.
Thank you.
Yeah, at the end of the project. That's what I mean. Sorry. So what it means is that you need to add the 25 to 20, then you get 60,000. But let's focus on the payback period. So the payback period, how do we calculate the payback period? How do you calculate the payback period? The payback period is the time frame it takes for you to recoup your investment. How much was your investment? Your investment was 160,000, right?
Yes, please.
Okay. So 160,000, year one will be able to take care of 40,000, year two, 50,000. Then for year three, about 70,000 out of the 90,000. So 40 plus 50 is how much?
90.
I don't know if you get my point. So 40, year one, 40,000 will be able to take care of year zero. Year two, 50,000 will be able to take care of year zero. By year three, means we need a balance of 70,000. So it will be 2 years plus 70,000 over 90,000. Does it make sense? Or it doesn't? If it doesn't make sense,
Yes, sir. Yes, sir.
You invested 160,000. So year one, they gave you 40. Year two, 50. So 40 plus 50 is 90. Year three, have 90,000. You only need 70,000 balance. So to be 70,000 over 90,000 plus 2 years, that will give you 2 years, 9 months, or 2.78 years. So that will be the payback. So the payback occurs during the third year, occurs during the third year. I hope that's clear.
Yes, sir.
Okay. Now let's look at this foreign investment appraisal question. Yeah, a past question came like that, so that would help. But it didn't, it was only in the pre-scene. It didn't show up in the questions. It was only in the pre-scene. This question says, a Nigerian company is considering an investment in a project in Ghana. The current exchange rate for the Ghanaian cedi is 50 naira to 1 cedi. The discount rate is 10%. The discount rate for similar project in Nigeria is 8%. The project will require an initial investment of 100,000 and lead to cash inflows of 50,000. Very, very important. So it's giving us two methods. You can use any of the two methods. And for anyone who has done MPV, this should be simple. But if you haven't done MPV, that's fine. We'll go through. The MPV of the project in Naira can be found as follows. So if you have done MPV before, okay, let me just go through because it's necessary that we understand it. So in year zero, right? In year zero, you have your initial investment of 100,000. Now, anytime you are doing NPV or net present value, you discount, or present value, sorry. You discount your cash flow into the present. Now, what does this mean? Very, very simple. So let me show you. In year zero, we are told of an initial investment of 100,000, right? So that's what we have in year zero. Now we need to multiply this by a discount factor, or a present value factor, to discount our cash flow to the present. Now, what is this present value factor? The present value factor is quite simple. The formula is simply 1 over 1 plus r raised to the power n. 1 over, let me see if so it's just, this is the PV factor, which is equal to 1 divided by 1 plus r raised to the power n. This is the formula. So what is the r? R is the interest rate, which is 10%. N is the year. This is the year. Right? I hope this is clear.
Yes, sir.
Okay, so this 100,000, you multiply by this present value factor. So 1 divided by 1 plus 0.1 is 1.1 raised to the power 0. Any number raised to the power 0 is what? 1. So in essence, it's simply 1. Because we are already in the present. Year 0 is the present, so it will be 1. So if you multiply 100,000 by 1, it should give you 100,000. Now let's move on to year 1. Year 1, we have a cash flow of 50,000. Our discount factor is 10%. So if you put in 10% here, it will mean that we have, our formula will be like this: 1 divided by 1 plus 0.1, which is 10%, raised to the power 1, which is equal to 1 divided by 1.1 raised to the power 1, which is not really necessary. So 1 divided by 1.1 will give us 0.909. So that's how come you have 0.909 here. Now you multiply 50,000 by 0.909, then you get 45,455. Now you move on to year 2. That's a cash flow of 50,000. Same principle again. You look at the PV factor or the discount factor. Or the discount factor, which is 1 divided by 1.1 squared raised to the power 2. Right? And that should give you 0.826. If you multiply that, you get 41,000. Now you move on to year 3, you have 50,000. Same process times 0.751, you get this. So when you add all your present values, you should get, including from year 0 to year 3, you should get 24,000. You should get 24,000. 24,000. Now, we know that the spot rate for converting CD to Naira is 1:50. So if you multiply 24,000 Ghana CD by 50, you should be getting the present value in Naira. I hope that's simple, right? So this is how you get net present value. Is that clear?
Yes, sir.
If you have any questions, just let me know. You know, focusing on the net present value alone should be very, very helpful. Should be very, very helpful. So yes, I think today this is where we'll bring this class to an end.
Thank you.
Yeah, I think that's where, God willing, next week though, it will be a lot because we would have to go through the past question. So please do well and study the past question. Thank you very much for joining and have a good week.
Thank you, sir. Enjoy the rest of the weekend.
Okay, bye.